Welcome to qiphyedu. Today we'll be looking at economics, paper 12, May, June 2020. Alright, let's start. Okay, so this is the first question. So here it says, which statement is the most valid reason for government intervention in a free market economy? A free market economy is where prices of goods, or I should say everything related, including the demand and supply, are determined by the price mechanism and market forces. So in this case, there would be less to no government intervention. But here, why would there be government intervention in a free market economy? So let's just look through it one by one. So for A, it says that consumers are well informed, making it difficult for producers to make profits. Now that's one main point of a market economy, free market economy, because first of all, a free market exists in order to have so that there can be a lot of producers of a product, which increases competition. When there's an increase in competition, consumers have a lot of options. They can choose which producer to buy the goods from, so it's very difficult for consumers to make profits. So the only way for these producers to make profits is either by increasing the quality of its products or by decreasing the price of their products, so more consumers will be attracted to purchase their products because of the lower prices. But this also depends on the elasticity of that particular good itself. So if it's inelastic demand, then for let's say good A and good B, which are the same things but from different producers, then if let's say good A is inelastic, so even though there's a decrease in price for good B, people will still go and purchase goods from good A instead of good B, unless it's elastic. Then only then there will be a higher significant percentage change in quantity demand over price, right? So A is definitely wrong. Okay, for C, producers are motivated only by profit. Well, that's exactly one reason why the free market economy exists, for profits, so this is also not correct. There are many competitive firms and not enough sole suppliers. Well, the reason why there is a free market economy in the first place is that there should be more competitive firms, right? So if there's not enough sole suppliers, then it's not really a valid reason for government intervention, because this is mostly for private goods. So private goods, the prices are determined by the price mechanism. So there are many competitive firms. So supposedly government intervention is not supposed to exist here. So this is also wrong as well. So B, it says that health and education are not available in sufficient quantities. This itself is a problem, because health and education comes under merry goods. So education is provided free if you are talking about education for primary and secondary education. That's free. Tertiary education is paid, but it is subsidized by the government if it's public university education. In this case, the government will provide free primary and secondary education through subsidizing it and also getting tax from taxpayers. So in this case, education is also excludable and does have the characteristics of rivalry. So in this case, if let's say if this allocation is left to the market forces, it will result in insufficient quantities, because producers are not sure of making a profit for these types of goods. So in this case, the government needs to step in and provide health and education to people who don't have these types of services in this case. So answer is B. Okay, number 2, what would not be considered a barter transaction? A barter transaction is when you exchange one thing for another, but there is basically no there's no money involved. It's like getting one item and then by exchanging it with another item, but it's not in the form of cash. So in this case, let's take a look at A. A car repairer undertaking the annual service on a plumber's van in return for the plumber fitting a new sink in the car repairer's kitchen. So there are two items. One is annual service on a plumber's van in return for plumber fitting a new sink, new sink in the car repairer's kitchen. So this is two things. So this is a barter transaction. Okay. C, a graduate student exchanging a set of textbooks. So one thing here, the first item here is a set of textbooks and a radio. So these are also two things. So this is correct. A train company allowing a phone company to advertise on its trains in return for the right to advertise on the phone company's website. So both are advertising on each other's I would say products or services. So this is also considered a barter transaction. So B, a consumer negotiating with a shopkeeper and buying a pair of trousers at $10 rather than the asking price of $30. You're giving $10 to the shopkeeper in exchange for a pair of trousers. In this case, money is involved. So basically it is not a barter transaction. So the answer is B. 3. A factory introduces an automated production line to take advantage of division of labor. What is most likely to increase? Alright, so a factory introduced an automated production line to take advantage of division of labor. So division of labor, so for example, a few workers are in this process A and some are in process B, some are in process C, and some are in process D. Right, so in this case, since it is automated, that means that you do not need to, so you do not exactly have to spend a lot of money on one worker doing so many things at a time. You are actually essentially just dividing the work between like maybe a few hundreds of workers. One is doing this, one is doing that, specializing in this and that. So they are only paid for that specific job. So they are technically paid lesser than they need. They're paid less than what the company actually has to pay for these workers, right? So in this case, let's take a look at A, average cost of production. So average cost of production will not increase because division of labor would decrease the average cost of production. Like I said, specialization, so you do not need to pay more to each worker. Instead, you're paying a specific amount because they're only specializing in some of these things. So the cost of production will decrease. So this is wrong. B, job satisfaction of workers is definitely going to decrease because a worker is doing the same exact thing over and over again. Okay, like if you are an operator working at a factory and you are just screwing in nuts and bolts every single day, you definitely won't feel very satisfied with your job because you are doing the same thing every day. Like you are just every day you go to work, you think that you have many new things to do, but at the end you're just doing the exact same thing you're doing like from yesterday. So it's repeating the same thing over and over again. So you're doing it like for almost a few years. For some people, they are doing it for they're doing it for a long time, right? So they won't feel satisfied. So this will decrease. Right. C, range of skills of each worker. The skills are the same for each worker. Well, because their skills are not going to change because they are specializing in different types of things, and then they are basically fixed into that particular job. So it's not like they're going to learn other things at the same time when they're screwing in nuts and bolts, and then they'll be able to learn how to weld in metal. So in that case, C is also wrong. So the thing that's only going to increase is worker productivity, because when you do the same thing every single day, you realize that since you're already doing it every single day, basically you will get to be able to understand basically what you're doing. Even let's say for example on day 1 you know nothing about this, but then day 2, day 3, all the way up to day 10, day 20, you realize that it's the same thing over and over again. So you can increase the speed because you already know how to do it and you're already used to it, so your productivity will increase. Okay, number 4, which statement is normative? Right, so let's take a look at B, C, D, because I have a hunch that A is correct in this case. B, a minimum wage is the lowest amount that employers can legally pay their workers. Now the thing is, there's no opinion there's no opinion on this statement because it is correct. It is factual and testable that a minimum wage is the lowest amount that employers can legally pay their workers. Like in Malaysia, the minimum wage is 1,500 ringgit. So the lowest amount that employers can legally pay their workers is 1,500 ringgit. So yes, that's true, and it is testable. In Pakistan, the minimum wage of 15,000 Pakistani rupees per month was set on 1 June 2016. It's telling you that a minimum wage is set on in this particular date. So it is factual and testable, and it's actual. So this is correct. Set as a positive statement. Setting the minimum wage rate above the equilibrium will result in excess supply of workers. So is it going to cause an excess supply? Yes, because This is the supply curve, and this is the demand curve. This is your minimum wage rate, and this is your equivalent wage. So when there's an increase in minimum wage, your supply increases. So yes, this is correct. So answer is A, because as you can see, a minimum wage is the correct government policy. When there is when this kind of word exists, this means that this is an opinion. It's not actually testable. It's actually just an opinion of, let's say, a parliamentarian or some person in a let's say opinion of a particular person. So in this case, this is normative, right? So, okay, question 5. In the diagram, D is the demand curve for an agricultural commodity, and S1 is the initial supply curve. A good harvest causes the supply curve to shift to S2. By how much will the demand curve have to shift to leave farm incomes unchanged? So, right. So in this case, we can see that for S1, the quantity is 2,000 tons and the price is $5. And then a good harvest will cause a shift to S2. So you can see that here, right now at S2, the quantity is about 4.5 tons, or 4,500 tons, and then the price is about $1 point something, right? So now a good harvest causes the supply curve to shift to S2, and now we need to know how much will the demand curve have to shift to leave farm incomes unchanged. Here is alright, so I think okay, so now this one is $5, this one is 2,000 tons, so I assume it's $10,000. Once you have it shift down this way, you realize that the demand curve is pointing at $1 something. I just assume it's $1.1, and then there's about 4.5 tons. So in this case, I assume that 1.1 tons, so this is $1.1, and this 4,500 tons, so we times 4,500. So we get something like 4,950, almost about $5,000. So in this case, in order to get same farmers income from the S1 curve and then the demand curve, that means that we need to divide 1,000 by 4,950. In this case, we'll get 2. Actually, we'll get more than 2, but in this case, 2 is almost closest to what we need. So if we shift the demand curve to the right, like this, you'll get 5,000 tons and $2, which is also $10,000. So in this case, we need to shift the farmer's income to the right in order to get the same amount that they earned before. So in this case, we'll shift the demand curve to the right, so we'll get 5 times 2, so we get 10,000. So in this case, we are shifting it by 1,000 tons, by increasing it 1,000 tons, because as you can see, there's a shift in the demand curve from about 1,000 plus. What am I saying? We are shifting this. We are shifting from, as you can see, we are shifting from 4 times 2 to 5 times 2. So we are shifting 1,000 tons to the right, right? So in this case, the answer is B. I don't know if I gave a good explanation on this or not, but what I'm trying to say is that, as you can see, initially the price is $5 and the quantity is 2,000 tons. Once the supply curve shifts to S2, you realize that the equivalent price is $1 point something and 4.5 tons. But then, because this is not a full number, so we look at this area here. So you can see that this is 4,000 tons and $2, which means that so if, let's say, assuming that we are selling at this quantity, farmer's income would be $2,000 short. So now, in order to get the same income, we move to the right, and then we'll get 5,000 tons and $2, so it's 10,000. So that's why it is 1,000 tons at all prices. So after we shift it like that, you also realize that everything here is shifting like so. So this one will ensure that the farmer's income is the same as before, right? So that's why it's 1,000 tons at all prices, right? A manufacturer progressively reduces the price of his product. The table shows the outcome of this policy. What is the price elasticity of demand? Okay, PED is the percentage change in quantity demanded over the percentage change in price. So in this case, we're going to divide, we're not going to divide anything, just have to look at total revenue. Total revenue is the same. So it's $750,000 when there's a change in price from $10 to $9 and then from $9 to $8, it's the same revenue. So every time when a decrease or increase in price will result in the same total revenue, this means that your PED is equals to 1. That means it's unitary. So answer is D. Okay, so for question 7, how does consumer surplus change as the price of product rises? Okay, so assuming that originally the price is at $0, right? $0 means that the quantity is 15. So I'm going to draw the area here. So when, let's say I'm increasing the price to $5, I actually remove the bottom component. So when I remove the bottom component, this is the only thing I have left. So you can see that this portion which I'm going to draw in red is the consumer surplus that has been decreased because of a rise in price. And then let's say I'm increasing the price from $5 to $10. So when I'm decreasing the price from $5 to $10, you realize that the portion or the area itself is actually getting lower and lower when I'm decreasing it. So instead of let's say I'm just going to calculate using the boxes available. So initially I'm removing 1, 2, 3, 4, 5.5 boxes, but then afterwards I'm only reducing 4.5 boxes. So there's a decrease in the amount of consumer surplus change. So in this case, if every time when there's a $5 rise, it's decreasing by 1 box. So it falls by a decreasing amount, right? So it's definitely not falling at a constant rate because the number of boxes that we are decreasing is actually not at a constant rate. It's actually at a decreasing rate. Okay, so it's not a constant amount unless the line itself is actually a straight line, then only then that's going to be possible. But here it's actually a slanted sloping line, so it's a downward sloping line. So in this case, it's actually decreasing by a decreasing amount instead of everything else here in the answer. Following the introduction of a 10% increase in charges for car parking in the city centre, the demand for bus journeys per day into the city rose from 800 to 1,000. What was the cross elasticity of demand with respect to car parking charges? Right, so cross elasticity of demand will be percentage change in QDX over percentage change in PY. Okay, two goods. So this one would be, this one you need times 100%, so this would be 25 divided by 10. 2.5, so answer is D. Alright, so it's just a matter of calculation. 9. An economy is suffering from a housing shortage. The demand for housing continues to rise as real incomes increases and more construction firms enter the market to build more houses, which diagram represents this situation. At the moment, the economy is suffering from a housing shortage. Demand for housing continues to rise, so D1 goes to D2. So anything that doesn't have that would be wrong, so this is wrong. This one is a decrease in demand, which is wrong. C would be considered okay in this case because D1 increases to D2, but let's look at the other things. First, more construction firms enter the market to build more houses, so there's an increase in supply. There's no increase in supply for C, so it's wrong, so answer is A. Right. A good has a price elasticity of supply of 2.0. The current quantity supply is 300 units per week at a market price of $20 per unit. The firm raises the price to $25 per unit. So what would be the new quantity supply per week? Firm raises the price to $25 per unit. So PES is 2.0, this one we know. So the PES would be percentage change in quantity supply over percentage change in price. So let's calculate the bottom. Actually we put in this first two, and then here we just say the price raised to $25 per week, so per unit, so 25 minus 20 over 22, right? So okay, so percentage change in QS 0.5. So right. So in this case, supply is 300 per unit, and then minus something. Actually, no. Something minus something divided by something. Let's just put x first, and then divided by 300 equals 0.5. So this would be 300 times 0.5, and then we will get plus 300, so x equals to 450. So in this case, answer is D, because of it's 450 units, right? 11. What is the major function of price mechanism? What is the major function of price mechanism? Okay, price mechanism, well, like I mentioned just now, it's actually to determine the demand and supply of a product in the market. It just measures the ability of a person to buy the product, but it doesn't measure it doesn't actually calculate the needs of a person. Like a person that is not able to afford the product will not be able to afford the product. So A, providing incentive for government intervention to reduce income inequality is definitely wrong. Removing shortages by creating incentives for market prices to fall is also wrong, because everything here, as you can see, anything creating incentives, everything here is all under government intervention. So this is wrong. Answer is D. Signaling changes in market condition. This is under the price signaling function. So answer is D. Diagram shows a supply curve of a product. Government imposes a specific indirect tax of $5 on the product. How will the PES of the product change? You can see initially S started out from 0, so it's unitary elastic. So in this case, we can use deleting the choices that we have. So everything A, B, C is wrong, because this is unitary elastic. So answer is D. Alright, answer is D. You could technically calculate it by, because you can see it imposes a specific indirect tax of $5. So if the price is 0, so you'll start from 5. Yeah, so we can technically consider it like that. So 5, so instead of 0, you get 5. And then instead of 5, we get 10. So here it will be something like this. Instead of 10, we get 15. So it will be something like this. So this is elastic. So everything that is, if let's say the supply curve starts from a specific price, it's actually elastic, or PES more than 1. If it starts from, let's say, the curve starts from the axis of, let's say, the quantity, then it's actually inelastic. So answer is D. Okay, 13. In the market for good, the quantity supplied and the quantity demanded are given by QS equals P minus 30 and QD equals 240 minus 2P, where P equals price in dollars. A change in the tax on the good makes QS equals to P minus 36. Let's calculate the equivalent price first. So we're going to ignore this thing at the moment. We're going to look at this. I'm going to shift the 2P to the left and 30 to the right. So we'll get 3P. This one is 270. P would be $90. A change in tax on the good makes QS equals P minus 36. So here we're going to find the changes in price after the tax imposition. So P minus 36 equals 240 minus 2P, move to left, move to right. So we'll get 3P equals 276, P92. So there's an increase in price to $2. So how would this change in equivalent price? It will rise by $2. Yep. Privatization can be achieved by the sale of shares to the general public or by the direct sale to a private company. The diagram shows privatization transactions and revenue for the European Union between 1981 and 2012. What can be concluded from this diagram? So you can see that for revenues from private sales in 1981, there's almost none. It's all public offers. It was only until 1986 you'll see that there are some revenue from PS. Then later on you will see that in 2012 most of the revenue is from PS instead of PO. So here let's look at the selections that we have. Any increase in the number of privatization result in an increase in privatization revenue. There's no evidence suggesting that that's the case, so we'll just leave that here. The average revenue for privatization was highest in 2000, which is wrong, because in 2000 you realize that the revenue from PO is relatively higher than revenue from PS, so this is wrong. The main revenue from privatization changed from public offer to private sales. Yeah, this may be correct, so we'll leave it there first, and then we'll take a look at D. The number of privatizations and revenue raised peak in the same year. Number of privatizations and revenue. Number of privatizations. Yeah, we look at transactions and revenue raised peaked in the same year. So that's wrong, because definitely not, because the number of privatizations and revenue raised do not peak in the same year. I mean, there's a difference. So you can see that the total revenue at the highest peak is actually in 1995, but at the time the number of privatizations is not a lot compared to PO, so D is wrong. And there's no evidence suggesting that any increase in number of privatization result in an increase in privatization revenue, because you can see the transactions decrease, and then you'll see there's an increase in revenue from PS, so it's upside down, so this is wrong. Answer is C. Diagram shows the market demand and supply curve for rice. What will happen if a government imposed a maximum price of $10? The equivalent price is $8, and the government imposed a maximum price of $10. So if let's say there's an increase of price of $10, it will result in a surplus, which is not favorable for producers, right? So in this case, government would need to supply Q1 to Q3, which is wrong, because in this case, right, it's not an effective maximum price. Producers will still continue to sell it at $8 because the maximum price is $10, so there's no point to increase the price. Quantity sold will be at Q1, which is wrong. Quantity sold will be at Q2, this is correct. Quantity sold would increase from Q2 to Q3, wrong. This is quantity supplied, so answer is C. A government decides to replace a private company with its own company to collect household waste. Why could such action be justified? Alright, so waste collection is not a public good, okay? You need to hire people, so it's actually considered private. Costs of waste collection are bound to be lower if paid out of local taxes. This is not really something that could be justified, because if you pay out local taxes, that means your expenditure, government expenditure, some of them will be used for this, which is not effective for actually improving the economy if the tax is used on just using it to collect household waste alone, so it's not correct. Private companies are always less efficient than government companies. This is absolutely wrong, because private companies, there are a lot of private companies, so this will result in competition. If it's government companies, mostly it's a monopoly, so there's only one company, so it will actually decrease efficiency, so this is wrong. Private companies might put profits before customer needs, is correct, because private companies tend to focus on profits, so this is D. Which measure would not be part of a government subsidy to protect domestic producers from competition? Alright, import quota is definitely a part of a government subsidy to produce, import quotas would not be part of a government subsidy to protect domestic producers from competition, because you are preventing imported goods to be sold at high amounts. This is not a subsidy. This is an imposed limitation. So form of protectionism, but it's not a subsidy. So this is wrong. This is correct. Interest-free loans provided by government is a subsidy. Reduction in profit and business tax is technically considered a subsidy by government. Transfer payments is also a subsidy. So import quota is not a government subsidy to protect domestic producers from competition, because import quotas is used to limit the amount of imported goods into a particular country. Although this is actually used to protect domestic producers from competition, it's not a subsidy. The producers do not gain anything. The only thing they gain is that consumers may be inclined to buying the items from domestic producers because of a decrease in quantity from imported goods. But if let's say the demand for imported goods is inelastic, then honestly saying, they probably may switch over due to shortage. So it does benefit, but not in the form of a subsidy. 18 of the country's railways are currently run by private firms. It has been suggested that the government should nationalize the railways. Alright, so why would this be a reason to nationalize the railways? So in this case, if you look at B, C, and D, to encourage competition is definitely wrong, because if you nationalize it, that means that it's a monopoly. The government is the one handling the railways. Increase profit incentives is not the main aim of the government. Provide jobs for local people, not exactly, because if you nationalize the railway, there's only one company, so providing jobs for local people, this may be a government's aim, but then at the same time, because you only have one company, that means that you have less positions and all, so job opportunities may actually reduce, so B is not correct. Most likely is to control prices of railway services, which is correct because there is government intervention. What is likely to cause a decrease in aggregate demand? So a decrease in aggregate demand, so assuming that we have two AD curves, so it shifts to the left. This is AD1, this is AD2. Here's our AS curve. So what is likely to cause a decrease? Alright, so an improvement in consumer confidence will increase AD, so this is wrong. Increase in government expenditure will also increase AD, so this is wrong. An increase in money supply will not really cause a decrease in aggregate demand. Both of these are not actually an increase in the money supply will only increase the AS. So if it increases the AS, it is not something to do with AD. So it doesn't concurrently change the AD as well. So D is wrong. An appreciation in exchange rate will result in an increase in interest rates. And when there's an increase in interest rates, people would be more inclined to saving money into banks instead of spending it. Because when there's an appreciation in the exchange rate, it's relatively more expensive to buy domestic goods. Or I should say it's relatively expensive to buy anything as a whole, so people will prefer to just put the money into banks, so A is correct. And then the AD curve will decrease, shift to the left. A country maintains its foreign exchange rate against the US dollar within a narrow but changing band. Narrow but changing band. What is the type of exchange rate? If it's not changing, it's fixed, that means A is wrong. So it's changing but it's narrow. So in this case, floating is not correct because floating means that it fluctuates a lot. So it's changing but it's actually high, it's actually of a different scope. So B is wrong. And this is not trade weighted because there's nothing that mentioned trade weighted here. So answer is C, it's managed. Which components are included in the financial account of the balance of payments? So financial account, this case that would be, we have three things: current account, capital account, and financial account when it comes to balance of payments. However, in the new syllabus, we are only focusing on current account. So these two are not in the AS syllabus for the new AS syllabus. This is in the previous AS syllabus, right? So in this case, interest, profits, and dividends are all under other than financial account. Basically under either current or capital. So in this case, it's wrong to say that interest, profits, and dividends are under financial account. So A and B is the most likely answer. So C and D is wrong. Foreign direct investment is also under financial account. So FDI will be under that, and then the balancing item is also under financial account as well. So answer is A. Which argument is an importer most likely to use to gain the support of consumers for free trade? Right, so free trade. More imports allow the government to raise revenues for tariff support of consumers. So we are looking at it from the consumer's perspective. This is from the government's perspective, so this is wrong. More imports improve the country's terms of trade. It's definitely wrong because terms of trade means that your country's export prices are lower than are higher than your import prices. So in this case, this is also looking at it from the government's perspective, so this is wrong. More imports raise total employment in the domestic economy. This is also, based on the government's perspective, or I should say producer's perspective, so this is wrong. If more imports increase competition in the domestic economy, this one will use to gain the support of consumers because consumers will have more options to choose from. So at the end of the day, the winners are actually consumers, because more imports, if it increases the competition, is actually bad for producers. In the case that they will have more competition, so they have to find more ways to actually improve the sales of their products. So in this case, I say C. According to US Consumer Price Index statistics, an identical good that cost $100 in 1913 would cost $2,359.60 in 2013. What was the approximate cumulative real inflation over the period? So we are taking base and also the current year. So 2359.60 divided by 100, we'll get let's see. we'll get 23.596. But rate of inflation, so when you times 100%, so when you times 100%, you get 2359.6. The approximate inflation will be roughly about 2,300%. So answer is C. Okay, so for question 24, which short-run measures should the government take to maintain the economy's current equilibrium if there's an unexpected balance of trade surplus? A balance of trade surplus is when your inflow of money is more than your outflow of money, which also means that your exports are more than your imports. So when your exports are more than your imports, this means your LYAS curve is shifted to the right. In this case, we realize that our price level has decreased on the same AD curve. So which short-run measures should the government take to maintain its current equilibrium? So in this case, everything here could be considered short-run measures, but then we need to see which one is the most suitable. So in this case, right, for this question specifically, higher government spending on education financed by an equal rise in direct taxation will result in an increase in AD and a decrease of AD at the same time, so meaning that there's no point. The higher spending on infrastructure financed by a budget deficit, which results in your if there's a budget deficit, meaning that your expenditure is more than your revenue. In this case, it makes no sense. Lower interest rates to promote investment spending in the private sector. Lower interest rates to promote investment spending in the private sector. So in this case, the short-run measure that the government should take to maintain current equilibrium will be this thing. So real output remains the same. So higher direct taxation with government spending unchanged. So government spending unchanged means AD will be constant, and then a higher direct taxation. So this would result in a decrease in AS. Because when there's a decrease in AS because of higher direct taxation, that means that your COP will increase. When your COP increases, it will shift the LYAS curve to the left, so maintaining the same price and also the real output. So answer is B. Right. Why does the value of a country's terms of trade have no monetary units? Alright. Terms of trade is the relative price of the price of exports relative to the price of imports. So it cannot be calculated accurately enough. Wrong. It includes more than one currency. No, it's only one currency. It measures change over time. No, it measures the changes of prices. It's not the change over time. So answer is C. Okay, 26. Statement that follow relate to possible gains from an increase in free trade. Which gain is least certain to result in the short run. So everything here, if it's long run, that means it's wrong, because we are talking about short run. Reduction in cost of production can be done in the short run. A wider choice of goods available to consumers, yes, this can be done in short run. An increase in level of competition, yes, it can be done in short run. A rise in the number of jobs, this requires expansion, requires investment, requires government and consumers it requires more profits and then the government can then or the producers will then spend more money on expanding their business, so this will increase the number of jobs. So this will not happen in short run, it will happen in the long run. So answer is B. In an economy with an interest rate of 4% per annum, the real inflation falls from 5% to 3% per annum. What will be a benefit of this? Many economies will fall to zero. Wrong. People on fixed incomes will be better off in real terms. No, because people on fixed incomes, because of the rate of inflation falling from 5% to 3% per annum, that means that yes, they may be able to get more items because of their higher purchasing power, but the ones that are really benefiting is actually not those people on fixed incomes, those people who are earning dynamic prices, dynamic profits instead of fixed incomes, because fixed incomes in real terms technically they are not the ones that are actually better off. So B is wrong. Purchasing power of the currency will rise, not exactly it's wrong, because of the interest rate, and savers will gain in real terms because the rate of inflation falls from 5% to 3%. That means that those that are actually benefiting are actually the savers, because they save their money into banks, right? Answer is C. Which combination correctly classifies an expansionary fiscal policy measure and its impact on the budget deficit? Fiscal policy is when it's basically based on the government's expenditure and also the tax rates. So interest rates here, nope, nothing to do with that. And then increased quantitative easing is also wrong. When there's lower income tax, there's an increase in budget deficit because your expenditure is more than your income. When there's lower income tax, means that you have higher disposable income. So C is wrong. Increased welfare spending will result in increase in budget deficit because of an increase in expenditure, so answer is B. Right, so in 2018, the US government introduced tariffs on a wide range of imports from China. Which type of policy was the US government adopting? Introduced tariffs. It's definitely not expenditure reducing. It's definitely not monetary because nothing to do with monetary. Monetary is exchange rate, interest rates, and also your money supply, so nothing to do with that. And it's definitely not supply side because supply side means that the US government imposes some helping to improve the economy by improving infrastructure and so on and so forth, which does not exist here. So it's expenditure switching, let's say changing, instead of buying your products from China, you buy it from somewhere else because of the increase in tariffs. Right. 30, during the Great Depression of the US government believed that deflation was caused by a collapse in the price of stock and other assets, reducing the level of wealth and confidence. Diagram show two approaches to counter deflation. Given this belief, which policy shows that the US government has used in an attempt to remove the deflation, and which diagram represents the intended outcome of the policy? Right, so removing deflation. Intend to remove deflation. Collapse in price of stock, level of wealth and confidence. So policy here, let's see. Decrease interest rates, intended outcome, diagram Y. They reduce corporation tax, diagram Z. If there's a reduction in corporation tax, the AS will increase. This is decrease in AS. This is wrong. Increase interest rates, diagram Z, no. Interest rates is when it's actually an AD component, so AD would decrease, but it says AS decrease, so it's wrong. Reduce corporation tax will not increase AD, it will increase AS, so this is wrong as well, so answer is A. Right, so that's it for today's paper. Do subscribe if you want to stay up to date with new videos, and I hope to see you again in the next video. Till then.